And the one, the only, the mortgage guru, Clinton Wilkins. What's it like to be a guru anyway?
You know, I think a guru is a good place to be.
Yeah, it's like Zen.
It's Zen.
You're mortgage Zen, aren't you, actually?
I am Zen on a normal day. I mean, you know what I'm not Zen about is, summer's on the decline. You know, we're the second week of August now, and, I think summer went by too quickly.
It absolutely did. Also on the decline, of course, thankfully, finally, interest rates.
The Bank of Canada.
Yeah.
What good news coming, in July with the second rate cut. Certainly, a lot of consumers want, the rates to be lower. I think the Bank of Canada is really focused on it not being inflationary. And we want, inflation to keep on going down. We want our consumer goods to be less, and we want the rates to continue to decline. And that's what we're really, really cognizant of. At the end of July, they reported that the GDP, increased a little bit. It was increased over the previous month where it was a decline. So I'm going to be watching very closely. The Bank of Canada meets again that first Wednesday of September. So we have a little bit of a break here before the Bank of Canada is announcing again. I'm on the fence. I think we might see a hold now after two cuts, but I guess we'll have to see what happens here the next couple of weeks.
How much does it actually? And it obviously depends on how much somebody's borrowing. But what does it mean, dollars and cents, when you have an interest rate cut?
You know what? It really depends on how much they borrow and really what their amortization is. Every mortgage payment's made up of an interest and a principal portion. Now, the rate's going down by 0.25 doesn't make a huge difference for those people that are in a variable or have a home equity line of credit. It's like a 3% reduction in their, borrowing cost. But I think every little bit makes a difference. And I think it's motivating for consumers. And we certainly have a lot more consumers that are choosing to go into a variable rate mortgage because rates are starting to decline. Now, economists, Scotiabank, for example, they're predicting maybe another 125 basis points of reduction between now and the end of next year. But there's other lenders. Their chief economists are predicting 175 basis points of a key rate by the end of next year. So by December next year, they're predicting that we're going to see, the rates be, up to maybe 175 basis points less than where they are now, which really means that we're going to see, prime rate in that 4% type range, which I think is going to be really great for a lot of consumers.
But that's a far cry from what it was at its historical lowest, right? What was the lowest it was? What was the lowest mortgage you wrote?
Ever,
yeah.
Well, it would be variable.
Yeah.
And at one time, prime was 2.25%, and we had, some consumers at like prime minus 100, so it would be like 1.25%.
1.25%. Wow.
I mean, and I think maybe there were even lower. I'm just trying to think in my head. I think there were some that were like sub 1%, believe it or not.
Yep.
It's going to be a while before we see rates at that level.
If ever again, potentially.
I'm not going to say ever. I'm not going to say ever, but I do think it's going to be a while.
So what would have to happen? What would the scenario be for rates to get to that?
Well, I think that inflation would need to be, again, very low or negative.
Flat for a long time.
The reason that they would lower rates to that level is to create inflation.
Right. Yeah, to stimulate the economy.
Get
people borrowing, get people spending.
Correct.
Right? Yeah.
Correct. Yeah. Exactly. So it's going to be a while. And, some consumers that are choosing to do these variable, they're like, well, I don't know what's going to happen in the U.S. I don't know what's going to happen with inflation. Typically, when we see rates starting to cut, they'll continue to cut until they plateau. Yeah. So it's going to be a long, long time, and it might even be 5 years before we start seeing rates increase again.
All right, so there was a lot of talk, and I'm sure you heard a lot about this and have witnessed it. There was this concern about what they call COVID mortgages, in which people were getting these historical low numbers, and they were coming up for renewal on the 5-year mark anytime, if not some already. And that's the calendar is pretty obvious. 2020, it's going to be 2025. So is there a concern about kind of people hitting this economic cliff when they have to renew this mortgage?
The ones that I'm concerned about are the ones that are in a static variable payment. So, and let's just be honest here. It's really lenders that are in the big five that have a static variable.
What's that mean, a static variable?
So that means I'm saying TD, Bank of Montreal, CIBC, Royal Bank, just for an example. Okay. The way that their variable works, when the prime rate changes, the payment doesn't change. It impacts the amortization. So some of those lenders, not all, but will allow a negative amortization. So in essence, you owe more every month than your previous month.
Right.
So your mortgage payment isn't even covering just even the interest. So
Yeah.
no principal is being paid.
Right.
Some of those lenders will allow like $1 being paid or a penny being paid. They'll allow like just the smallest amount of principal. That's still like an amortization for infinity.
Mm-hmm.
Some will have like a reset rate where eventually your payment will reset.
Yeah.
But those consumers need to be so concerned when their mortgage comes up for renewal. They either need to do a lump sum payment to kind of bring the amortization back in line, or they're going to see their payment just skyrocket. So we're seeing those consumers proactively, either at renewal or before renewal, choosing to refinance their mortgages and then re-amortize. So it might be re-amortized over 30 years, re-amortized over 25 years. And yes, they're seeing their payments go up, but they're not letting it get to the point where the bank is dictating, hey, this is your new payment, and your amortization now needs to go from infinity to 20 years or 15 years or whatever.
It was a static, is that what you called it?
Yeah, so that's a traditional variable. The ones from the bank would be the traditional way.
Yeah.
The rate changes, no payment change. Most borrowers these days, where we're doing the mortgages, have an adjustable rate payment, where prime goes up, payment goes up, prime goes down, payment
why
goes
would
down.
people get into a static variable?
People want to know.
They're banking on interest rates not going up.
They're banking on interest rates not
gamble.
going up, and they're okay to say, okay, we may have some changes within this like 5-year period.
How much
for
would
example.
some of these lump sum payments be? I would think they would be pretty big.
Depends how big the mortgage is.
Like we're talking potentially tens
Big
of
money,
thousands of dollars.
big money, baby.
So if you can't do that, then that money's got to that's on the books.
Well, then you have to start making a bigger payment.
Then you have to your point, remortgage or refinance the mortgage.
When we're talking about a cliff, these are the ones that I'm most concerned about.
Yeah.
Yes, I'm also concerned about those people that are in a fixed rate that were in the very uber low sub 2%.
Yeah.
I'm concerned about these folks
But
too.
they've already been realizing the increases, which is
I don't think so.
No.
I think the ones in the static variable,
Yeah.
and I think the ones with the uber low fixed rates,
Yeah.
I think are still going out and buying new vehicles, eating out. I see these people around town. Trust me, I'm out and about.
Yeah.
I see them buying their new cars. I see them on Facebook and Instagram.
Nothing drives you more nuts when you're writing a loan.
And I'm less like,
and people are buying cars. That drives you crazy,
oh my
right?
Goodness. You know what? We deal with people in the car industry all the time, and I'm sure I'm like their nemesis or something.
Yeah.
But honestly, auto debt is just the worst.
Yeah.
It is honestly the worst. And people buy much nicer vehicles than they can really afford.
And negative equity dumped into it as well,
Goodness.
right?
It's so unregulated. Where mortgage lending, we talk about all these nuances. It's so complicated. We have to dot every I, cross every T. But the reason that it's so challenging is the government, the mortgage origination business, the banks are all trying to protect the consumers. And we're trying to protect consumers from themselves.
Yeah. Yeah, sure.
Canadians have an unsatiable taste for debt.
Yeah.
And Canadians are so indebted that, one little impact, just like when these rates went up.
Yeah.
We're only talking 18 months of the rates being high.
Yep.
We have a very short-term memory here.
But you've often
can be problematic.
but you've often said, and there's empirical data to back this up, that Canadians traditionally pay their mortgage first.
They do.
Yeah.
And still to this day, even though we're seeing maybe these renewal cliffs happening and all this stuff, the arrears are still very, very low.
Mm-hmm.
Yeah, sure, they're peaking up a little bit, but overall, Canadians did a very good job at paying down their debt and getting their finances under control in 2020. We didn't have any place to spend our money.
Yep.
It's going to be these later years. We're going to start seeing more losses. We're going to see more losses from businesses, so they're going to see businesses going under. And we're going to see more consumers in some areas, specifically GTA, Vancouver. We're going to see more consumers selling their home because they can't afford this home at renewal. Here in Halifax, maybe not so bad. I think we're more conservative overall.
Yeah.
We're going to see some people, but guess what? We need the inventory here
Yep.
a lot more.
Yeah.
And there's more demand in this market than there is supply.
Yeah, it's interesting. I saw a story about housing starts in Ontario that was startling, and I wanted to talk to you about that. But let's save that for the last segment of the show because
We'll definitely talk about the real estate market. We have a wonderful guest coming on.
Talk about that.
We have Danielle McLean coming on from DCL Law. She's joined us on our show before during Financial Literacy
On the
Month.
phone, though. She's in studio this time.
She's in studio. She's a real estate lawyer here. She practices in Halifax and Dartmouth. And we're going to talk to her all about how does real estate law really work and what are the impacts, in terms of a deed, mortgage, and we're going to have a lot of really great questions for her.
If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.